Today's episode covers regulation debates, a major autonomy decision from Rivian, the return of a city-sized EV icon, questions about battery investments, and a near $30 billion reset from one of the world's biggest automakers. Welcome back to Autonews Daily. I'm Leah Morgan. Let's dive into today's headlines. The first story this morning focuses on the cancellation of a planned 2035 engine ban and the mixed reaction across the auto industry. Automakers are publicly divided. Some see the move as an opportunity to preserve greater flexibility in powertrain choices, while others worry it introduces uncertainty into long-term planning for electrification. That split highlights a deeper truth. Regulatory clarity or its absence directly shapes investment decisions, factory roadmaps, and the timing of new product launches. Many companies had already been planning around strict phase-outs for internal combustion engines, so this reversal forces a reevaluation. For manufacturers that had committed heavily to electric powertrains, the cancellation can feel like a setback in shaping a uniformly regulated market. For others, particularly those with large fleets or investments in hybrid and efficient ICE technologies, it eases a near-term compliance burden. The conversation now centers on whether this pause will slow EV adoption, accelerate hybrid strategies, or simply create a patchwork of approaches across different markets. Either way, engineers, planners, and dealers are watching closely because regulatory signals are one of the biggest levers that determine where automakers put their capital and how quickly they change product portfolios. Moving from policy to technology, Rivian's announcement that its R2 model will not be offered a Lidar retrofit is the next headline. This decision tells us a lot about both customer expectations and how OEMs are prioritizing sensor suites for mass-market EVs. Lidar, long touted by some as a must-have for fully autonomous driving, remains expensive and logistically complex to integrate, especially if a company expects large volumes and tight price points for a lower-cost model like the R2. Rivian's choice leans into a sensor strategy that relies more heavily on cameras and radar and signals a continued industry debate. Is Lidar essential for the next phase of advanced driver assistance, or can software and cheaper sensors close the gap? For owners and potential buyers, the practical implication is clear. Some advanced autonomy features that rely on Lidar will likely remain manufacturer-installed and not available as later aftermarket upgrades. That influences resale value, upgrade paths, and the expectation of what driver assistance will mean in the coming years. From a broader perspective, Rivian's move will be watched closely by other EV makers and suppliers weighing the costs and benefits of Lidar versus lower-cost sensor architectures. Keeping an eye on the smaller end of the market, the Smart Fortwo's return as an electric vehicle illustrates demand for compact, city-focused EVs. The Fortwo has long been a niche product built around maneuverability, minimal footprint, and urban convenience. Its revival as an electric model underscores that there's still appetite for small, efficient EVs designed for dense metropolitan areas. For urban commuters and fleet operators, a reintroduced Fortwo can offer a lower-cost, lower-complexity option compared with larger crossovers that dominate many EV lineups today. What makes this interesting are the market dynamics. Many automakers shifted away from very small cars as profit margins tightened and consumer preferences moved toward SUVs. But cities worldwide still face congestion, infrastructure constraints, and parking scarcity, and policymakers are looking for low-impact mobility solutions. A renewed Fortwo could therefore find a comfortable niche if it combines practical range, accessible pricing, and smart urban design. It also serves as a reminder that electrification isn't a one-size-fits-all story. Product diversity matters if automakers want to serve different use cases and income brackets. Turning now to the supply chain and manufacturing side, there's growing attention on Ford's recent EV reset and the reported multi-billion-dollar hole in the battery industry tied to those adjustments. Even as manufacturers announce ambitious EV plans, the battery segment remains one of the most volatile and capital-intensive parts of the transition. Shortfalls, shifting demand forecasts, and the high fixed costs of gigafactories can create substantial gaps between planned capacity and actual returns, and that gap is now being called out as a multi-billion-dollar challenge. For Ford, and for the industry at large, the lesson is that scaling battery production in lockstep with vehicle programs is difficult. Contract negotiations, raw material availability, chemistry choices, and the pace of customer uptake all affect the economics. The immediate consequence is that automakers may need to rethink timelines, renegotiate supplier deals, or absorb higher costs while they retool strategy. Longer term, this will pressure companies to sharpen demand forecasting, diversify supply, and possibly accelerate investments in recycling and second-life applications to improve overall battery economics. It's a complex puzzle where technology, markets, and policy all intersect, and the outcome will influence which players can compete effectively in the EV era. If you find these daily updates useful, please like and subscribe. It helps us keep bringing the news to you. Finally today, the biggest item on the agenda: Ford's revised electric car strategy that will cost nearly $30 billion. This is a major financial commitment and a strong signal that even after strategic resets and supply chain challenges, Ford is doubling down on electrification at scale. The nearly $30 billion figure reflects a comprehensive reassessment of where capital needs to go, from product development and manufacturing to charging, software, and the broader ecosystem that supports electric mobility. What matters most about this announcement is its scope and timing. A single company infusion on this scale will ripple through suppliers, partners, and competitors, influencing everything from battery sourcing to dealer preparations and workforce training. For investors and industry observers, the key questions are execution and return on investment. Can Ford translate this large commitment into vehicles that meet customer expectations for quality, range, and price, while also building the necessary charging and service networks? The decision also underscores a broader reality. As automakers move toward electrified portfolios, success will depend not only on vehicle hardware but on software, customer experience, and the full value chain that supports EV ownership. Across all these stories, the common thread is adaptation. Whether it's responding to shifting regulation, deciding which sensors belong on a mass-market car, reviving a compact EV for city dwellers, plugging gaps in the battery supply chain, or committing tens of billions to a revised EV plan, automakers are constantly recalibrating. The pace of change is relentless, and each strategic choice carries downstream impacts for suppliers, dealers, and drivers. Thank you for listening. See you tomorrow with the next round of industry updates.